Hello, everyone, and welcome to the Viking Wealth Show. You really want to tune into this show because you may be sitting on a lot of retirement money and want to put it into a higher yield investment or diversify your investment. If you have these questions or want to learn more, we are thrilled to welcome today Reneika Lightbourne. As a business development specialist for Advanta IRA, Reneika educates clients and investors about self-directed IRAs to invest in real estate and other alternative assets. Furthermore, Reneika actively self-directs her own retirement account. So you're your own best customer at Advanta. So welcome, Reneika.
Thank you. Thank you so much, Viking Capital, for hosting, for allowing Advanta IRA to participate and knowledge share with your audience.
Excellent. Well, really happy to have you. And let's go ahead and get started with some simple questions. Maybe you can answer for our listeners, what is a self-directed IRA? What's a solo 401k? What's the difference? How are they beneficial?
Okay, great question. Very simply, a self-directed IRA just simply means that you, as the account owner, you have complete control over your retirement funds. It allows you to really diversify into alternative assets. So anything other than stocks and bonds. The account type is the same, and we'll talk more about that, but you get to use IRAs or solo 401ks to invest in real estate, like we're going to be focusing on today, or anything other than the traditional markets. Solo 401k itself, well, let me say first and foremost, IRAs, whether it's traditional or Roth, is designed for individuals, whereas solo 401ks is specifically for business owners, entrepreneurs. So if you have a side job, let's just say, whether you're a 1099 or you have an entity, it's designed specifically for those business owners to put more funds away for their retirement account. So IRAs, individuals, solo 401k business owners.
Okay, so if I have a W-2, I can get a self-directed much easily, right? Much more easy.
So if you have a W-2, you can participate in an IRA, but you also have the ability to participate in a solo 401k if you have a side job outside of your W-2. But yes, IRAs are specifically for individuals. As long as you have earned income, you can participate.
Okay, I got it. So if you have W-2 income and a side hustle, you could do either or. If you just have W-2 income, self-directed IRA is the way to go.
Exactly. That's spot on.
Sounds like a lot of our investors. So I heard that you also have a self-directed, just like myself, right? So why did you switch from a self-directed retirement account from a more traditional 401k?
So for me, like the old saying go, if you want to, play sports, to be around, athletes who play sports. If you wanted to, for me, I wanted to be an investor. So I kind of, got affiliated or connected with real estate investors, and self-direction came up, pretty often. And I love the fact that you can use those retirement funds to put it to work, investing in something I know, something I understand. I still have some funds in a traditional market, meaning we don't try to pit against the traditional stocks and bonds, but I say diversify, allow you to invest with, something that something that you understand, something that you're comfortable with. And for me, it was real estate. So it was a no-brainer to, take a portion of my account and put it to work. And then ultimately I transitioned over here at Advanta on the professional side of it. So.
Yeah,
I see. So you personally decided you want to diversify your investment or your retirement funds. If we have other listeners that feel the same and have W-2 income and maybe have retirement funds through their job, can they still do that? Is that still possible?
So yeah, if they have an existing IRA, they can move as much or as little as they want to or need to. It's an IRA trustee to trustee transfer. If they have an existing 401k with their current employer, there may be some restrictions there. So if they're not retirement age, which is 59 and a half, and it's the current employer plan, most times that employer may say, hey, no, you can't move it. But you can certainly ask or inquire. If it's an IRA, you can move it at will. If it's an old 401k, a lot of times we've left, we've left old jobs and those funds are just sitting there idly. Those ideally you can kind of, move it over and put to work. For me, I knew I was going to transition out of my previous role just because I wanted to, get more active with investing. And I'm like, okay, well, I've learned it. I know it. I understand it. Let me put it to work. And that's, my personal journey in terms of just moving a portion of it that I felt comfortable enough to start.
Yeah. And that's exactly what happened to me. I was in a W-2 job prior to Viking Capital, where I could not transfer those funds in my 401k to a self-directed IRA. I did have some funds from a previous job that was in an old 401k account, and that was what I transferred over into the self-directed IRA. And that was an easy transfer, just as you mentioned. I was able to invest it into real estate from that self-directed IRA. So that's exactly what happens. What are some tips or methods the investors need to know about switching funds over? Can any account be switched over? For example, a 403b. What should they know?
Okay. Again, great question. So any IRA, qualified retirement account, like an IRA, whether it's a traditional Roth or a SEP or simple, or employer-sponsored plan, like an old 401k and old 403b, qualifies to be self-directed. The process for that is pretty straightforward. If it's an IRA, then of course, it'll be a trustee-to-trustee transfer. In that scenario, Advanta, as the receiving custodian, would initiate that request on your behalf. If it's an old employer plan, like an old 401k or 403b, then of course, in that scenario, you as the account owner have to initiate that. I will walk and guide you through the steps, but you would have to tell your old job, you want to move the funds. You're not taking a personal distribution. It's just going to another qualified retirement account. The process for us is pretty straightforward. When you're ready, fill out the paperwork. We'll guide you through that. Step 2 is funding. In this case, moving it over from that existing retirement account or from an employer plan. And then step 3 is, making your investment. So in this case, if it's a project that Viking Capital has or some other real estate related investment.
So that sounds like 3 easy steps. I'm talking to a few investors right now that are trying to do that. And I'm just curious, what type of hiccups or what type of challenges might delay that? And how long does that typically take to switch it over?
Okay. The process, we've really perfected and streamlined that for our clients. If it's an IRA account, for any account, we get our client's account open pretty quickly within 24 to 48 business hours. Step 1, again, is filling out the application, our advanced application packet. If it's an IRA, it can be done electronically directly on our website, or myself or one of my colleagues can send you a DocuSign link. DocuSign obviously will prompt you to fill out the bulk of everything that's needed. If it's a solo 401k, which is a little bit more cumbersome, we typically allocate at least 45 minutes to an hour to get on a call and walk you through the paperwork, just because it's a little bit more manual and more intensive. But the account opening process is pretty quickly. The funding, depending on who the other custodian is or where the funds are coming from, that can be the bulk of it. So for instance, certain custodians are pretty quick where they can send the funds wire, or, they can cut the check pretty quickly within, 3 days. Other custodians, it may take them a little bit longer. So the funding depends on, where the funds are coming out. Well, the turnaround time depends on where the funds are coming from. And then, of course, once your account is open, it's funded, there is a 7-day right of rescission for you before you can actually make an investment. And then, of course, finally, step 3, once that 7-day window is open and your account is funded, you're ready to make that purchase or make that investment.
Interesting. So it sounds like the biggest hiccup might be getting the check from the old custodian. Like I remember Fidelity for myself took about a week, and for my friend took about 3 weeks before I was able to get it into your account. So that's really interesting. A lot of our investors are investing in things they understand, such as real estate, but are there any restrictions in what you can invest in within real estate?
So for any investment, it always have to be for investment purposes, meaning if it's a property, let's just say 123 Main Street, you can't live in that property. So you do want to be mindful of the few rules and restrictions. So it has to be for investment. You can't, live in that property, or you can't do any of the sweat equity. So let's take it back really quickly, and then I'll drill down a little bit further. In terms of the two types of investments that you cannot purchase in your IRA, it's life insurance and collectibles. Collectibles is, pretty straightforward in terms of anything like antique art, wine, stamps, anything of that nature.
Michael Jordan basketball.
I'm sorry?
Michael Jordan basketball cards are okay though, right?
No, believe it or not, Michael Jordan's one of my favorite players. Okay. I actually started watching basketball because of him. So as much as I would like to have a collectible card, no, you can't put that in your IRA.
Okay.
So collectibles and life insurance. And then the other restriction, going to your original question, is prohibited transaction. So when it comes to self-direction, you have to be mindful of who your IRA is actually transacting with or not allowed to transact with. In this case, a disqualified person, you as the account owner, your spouse, and any lineal ascendants or descendants, meaning parents, grandparents, children, grandchildren. So when you make an investment, again, investment purposes only, you can't do any of the sweat equity in that property or a project. So you get to oversee everything. You get to decide what needs to get done, but you can't be the one that's doing any of the actual investment. For your clients, because they're more so passive investors, they may not run into this issue. But just for knowledge sharing and general information, any investment is for investment purposes. No sweat equity, no self-dealing, meaning your IRA can't be on the opposite side of the table from yourself, your spouse, any lineal ascendants or descendants, or your business or entity that's owned or controlled by that disqualified person. I know that's a mouthful, but we can break it down a little bit more if needed.
Yeah, from my experience, when we sponsor a deal, I can't invest in it with my self-directed. My wife can't invest in it. So we typically don't use our self-directed IRA for our deals. Any other deals?
You certainly can. Yeah, that's correct.
If someone has the option to do solo 401k versus a self-directed IRA, which one would you suggest they pick?
So based on that person's discretion or personal situation, if they do have their own business or a side business, or they're starting a business, then obviously with the solo 401k, it does have a lot of great or added benefits compared to an IRA. With the solo 401k, you do have higher contribution limits. So for instance, with IRAs, you can only put in $6,000 to $7,000 a year, depending on your age. Whereas with the solo 401k, you can put in $61,000 to $66,000. It's going to go up a little bit more next year, but you have higher contribution limits. For real estate investors specifically, they like the solo 401k because they're not subject to UDFI tax, and we'll touch on that a little bit more. So that's another benefit specifically for real estate investors. Not that I'm advocating it, but the solo 401k also have that loan provision. If you wanted to take out a loan from your solo 401k, obviously you would have to repay it, but you have that as an added benefit. And you have the ability to have a Roth component built into your solo 401k with us as well. So it's a number of different reasons as to why, if you're eligible for a solo 401k, you may want to look at that as an option. Obviously, talk to your CPA or tax person. But if it's on the table for you and you're looking to maximize or take advantage of, all of the benefits and the higher contributions, then definitely solo 401ks.
And you have more control over that account as well, correct? Like you have your own checking account that you actually have overall control in for a solo 401k.
So first and foremost, with self-direction as a whole, whether it's IRA or solo 401k, for your clients or the audience in general, just know that you're always in control, meaning nothing happens until you say it does. With IRAs, to your point, Ravi, you're alluding to checkbook control, or sometimes you may hear it referred to as an IRA. You can certainly do that with an IRA as well, meaning you make the investment indirectly through an LLC that's owned by your IRA. Or with a solo 401k, you can do the same structure as well, meaning with solo 401ks, you're the trustee of your plan. But with us, we have 3 options for our solo 401k. We have a do-it-yourself. You're just simply leasing that plan document and you open up a bank account for that 401k. That automatically gives you that check for control type feature built in automatically. Or if you look at one of our other solo 401k options, like our standard or enhanced, if you wanted to utilize what's called, again, check for control or an LLC structure, you can do that with your solo 401k. But with both plans, you're in control. With the solo 401k, again, as the trustee, you have greater flexibility with it.
Interesting. I actually didn't know that you guys had solo 401ks. I thought you had only self-directed.
No, we have all of the retirement accounts like IRA, traditional Roth, SEP, Simples, HSAs, ESAs, and solo 401ks.
Yeah. And one thing, I know we're going to circle back to this, but UDFI tax, I believe that liability is actually offset through the cost segregations and the passive losses. And I know we're going to circle back, but for the listeners, don't get too scared by the tax, because there's things that we do to account for that.
Yes. And another benefit to solo 401ks is UDFI. UBIT still applies to both IRAs and solo 401k. And let me explain. So UBIT is unrelated business income tax. UDFI, which is like an umbrella underneath UBIT, unrelated debt finance income. UDFI applies in IRAs. It doesn't apply in solo 401ks. And if I have time, I can give you an example of, just the difference of how it works if you want me to.
Yeah. Let's get into that.
Okay. Yeah. So in an IRA, very simply, let's just say 123 Main Street's out there for $100,000, And even if your IRA had all of the money to purchase a property, but you didn't want to tie up all of the funds in one property, maybe you wanted to diversify and buy multiple properties. Well, let's just say for simplicity, 123 Main Street's 100,000. Your IRA is going to put down 30,000 as a down payment, and you wanted to take out a loan for the remaining 70,000. The loan type itself has to be what's called a non-recourse loan. Non-recourse just means you as the account owner, you're not personally guaranteeing that loan. It's actually your IRA that's taking out that loan. We can provide you a list of comprehensive non-recourse lenders out there, or you can connect with your preferred lender to see if they offer that. But let's just say you put down the down payment of 30,000, you take out the non-recourse loan of 70,000, you fix that property up and you sell it. In an IRA scenario, 30%, the amount that you put down, that the IRA put down, is going to flow back into that retirement account without any tax liabilities. Whereas the 70% that was leveraged, that was borrowed, would be subject to UDFI, unrelated debt finance income tax. Obviously, as you repay that loan, that UDFI tax goes away. You can work with your CPA to see if you can get some tax breaks as it relates to UDFI tax, but that does apply in an IRA. Same example in a solo 401k, property's 100,000, your solo 401k put down 30,000 as a down payment. You still take out a non-recourse loan for that remaining 70,000, meaning you're not personally guaranteeing that loan. It's the solo 401k that's taking out that loan. You fix the property up and you sell it. 100% of that profit flows back into the solo 401k without being subject to UDFI tax. And that's why real estate professionals, real estate investors like yourself really find the solo 401k to be most attractive.
Yeah, and don't let the taxes scare you.
Exactly.
It's still an income stream. So don't let the tax tail wag the investment dog. Sometimes people hear that there's these UDFI or UBIT taxes and they go, well, I don't want to invest. It's like, it's still an income stream. You're still leveraging your time. So does that make sense, Ravi? People.
Yeah, absolutely. And people have that question and that concern often, but I've done a lot of these self-directed investments, and actually that has never come up because every year there's a loss, and we continue to have passive losses so that we're not subject to any taxes in that account. And then once a deal's sold, and you reinvest that money into another deal, then you get more losses on top of that, so you're not subject to those taxes. I think and Reneika, you may know this, but the taxes are a concern once you start taking, if in a real estate investment scenario, those taxes are a concern once you start taking that money out and you don't invest that into a deal where you're getting constant losses from K1s. Is that basically when you should be worried about those taxes?
So when you make an investment in the retirement account, is tax sheltered. So depending on the type of account that you have, if it's traditional like a tax deferred account, then obviously when you take taxes out later, you account for it. With a Roth account, you've already paid taxes on that. You grow that account over time. Once you reach retirement age, as long as you've had that Roth account for 5 years, when you pull the funds out, it's tax free. So it depends on the type of account that you have, in terms of whether you're going to, be subject to possible taxes in terms of earnings coming in.
Okay, so it's account dependent. But if you have like a standard self-directed IRA, where you're investing funds so you invest, say, 50,000, your deal has an equity multiple of 2x in 5 years, and in 5 years you get 100, you reinvest that into another deal. With that, in that time period,
you're not subject to any taxes. Yeah,
you're not subject to any taxes.
No, it's going to grow tax deferred until you actually take funds out at retirement age.
Yes.
So that's the beauty right there. That's the beauty of self-direction, meaning, let's just say taking it out of a retirement account, let's just say someone does a fix and flip personally or through business, and they fix a property up and they sell it. When they sell it, they're subject to capital gains. Whereas if you were to do that same investment inside the retirement account, tax sheltered, all of that income would flow back into the retirement account, and you won't pay any taxes on that. Again, depending if it's a traditional IRA or tax deferred account, you'll pay taxes at a later time.
Okay, and then tax is a concern. Fees are another concern people have. So what kind of fees would you expect with these types of retirement accounts?
Okay, so with us at Advanta, we're not the highest in the industry in terms of cost, but we're also not the lowest. Our focus is providing our clients that concierge style service. So there's really 3 main fees for our clients to be concerned about. There's other applicable fees, but again, it only comes up if it applies. But there's an opening fee of $50. And then, of course, there's a transaction fee when they buy or sell. So transaction meaning, they make an investment into one of the Viking Capital's syndication project. That's a $95 transaction fee. And then on an annual basis, Advanta, we have to do all of the record keeping, all of the IRS reporting, depending on, there's two options. Option one is a flat asset fee. Option two is value-based. Just for simplicity purposes for one of your clients, it'll be a one-time fee of $50. A transaction fee when they made that initial investment into your project would be $95. And then on an annual basis, it'll be a $295 for us to do the record keeping. If they require additional service, meaning they wanted us to wire the funds, in that scenario, we incur a wire fee, so we would pass it on to the client. Or if they wanted us to express mail something, just like if they were to go to UPS or FedEx, in that scenario, we would incur a fee, so we would pass it on to them in that. But if they don't use it, it doesn't apply. Still a 401ks, the price point is a little bit different, but we have three options. We have a do-it-yourself plan. That's pretty straightforward, where we're just leasing our plan document. And to lease our plan document is $300 a year. Whether you're with us or someplace else, you have to have an IRS-approved plan document. So the do-it-yourself, you're just leasing that. The standard, it inquires a little bit more, just because, again, we're helping you with maintaining that account. And then with the enhanced Advanta, at that point, we're doing everything for the account. But if you have specific questions about, the pricing, we can go through it, on a one-on-one consultation.
That's interesting, because if you think about the size of the investments, those fees are basically nothing.
Nominal, yeah.
And then also the fact that you guys have such a large company and so many clients, you really must have economies of scale to have fees that low. Because I've seen, when I was looking at different companies and, see pricing all over the place, and it's nice that you have a flat fee versus a percentage fee. Sometimes there's these percentage fees out there, and those fees can get really large if you're not careful. So anybody that's listening, I recommend talking to Reneika, but definitely if you don't like what they have to offer, make sure that they have a flat fee.
Exactly. And that's one of the things that this differentiator separates us from our competitors. Again, our focus is quality service, great educational content, but also too, making sure that we provide a valuable and affordable service. And our clients have access to an online portal with us. They have a dedicated account manager that's pretty much going to be with them for the life of their account with us. So for instance, all of Viking Capital referrals will have an assigned person just to kind of help streamline, help with continuity. I know for me personally, when I was, looking at self-direction, I looked at every company out there. I looked at other companies. I checked underneath the hood, and Advanta definitely, checked the boxes for what I was personally looking for. So that's why I went with them as a client first. I've been with Advanta as an employee, but I've been a client since 2019, but a client for about 5 years now. So that was something that was, concerned for me, making sure that I'm going with the best company. And obviously now I'm on the other side of it. It's like a no-brainer. Like, we want to be able to serve you as a client.
I can speak to that as well, because I've looked at Advanta, I've looked at other self-directed IRA companies, and to Colm's point, the fees are all over the place, and nobody, and I'm not just saying this because Reneika, you're on the call, but I have not had as smooth of an experience with any other self-directed company compared to Advanta. I mean, it's just like, I've had nightmare experiences with other ones where they delay, sending funds, or, there's a lot of red tape you have to go through, and the investor gets really upset about certain things. So there are a lot of factors out there. It's not just the cost, but it's their experience. It's how big of a company they are. So, again, I'm not saying go with Advanta only, but my experience, I've tried like 5 different self-directed companies. It was very smooth with Advanta.
And I would have to say that goes to our leadership team or our owner. It's a small company, but it's a great company to be a part of. So,
is there a limit to how many real estate investments you can make through your IRA?
No, there's no limit in terms of you can have as many holdings in your retirement account as you want to. The only thing I do want to kind of clarify with that is just with wholesaling. Sometimes it's clients refer to as wholesaling or assignment of contract. You do have to be mindful of how many wholesaling transactions you're doing within a deal, but specifically for your clients with syndications or more so passive investors, there's no restrictions or limitations there. Wholesaling, or assignment of contract. Yes, you want to be mindful of how many deals you're doing, because now you don't want the IRS to look and say, hey, am I operating a business inside of my retirement account? That's the only thing I would kind of highlight. For your passive investors, no, they can have as many investments in there as they want or need to.
Okay. And what if Colm, for example, invests in his Michael Jordan cards through his self-directed IRA? How's anybody going to know about it? I mean, he's got access to the account. He writes a check. I mean, how's that even looked at?
So obviously, if you know the rules, you want to follow the rules. I'm not advocating that you go out and do something, inadvertently. Whether it's inadvertently or on purpose. But if you know the rules, you want to follow it. Just because in an IRA scenario, let's just say you made a mistake, you did a prohibited transaction, whether it's purchasing a collectible card or not, and the IRS end up doing an audit and they find out. Well, your IRA possibly will, most likely, if it's considered prohibited, will cease to be an IRA, meaning the funds would be pulled out of the account. You'll pay taxes and penalties because you did a prohibited transaction. And a solo 401k, not so much. And again, that's another benefit of a solo 401k. If you were to make a mistake in your solo 401k, they're just going to look at that specific transaction. You have to rectify it, but your entire solo 401k is not in jeopardy. In an IRA, it is. In terms of, I tell clients, the simple analogy is if you drive a car and the light says red, you stop. If it says green, you go. You can drive from East Coast to West Coast. You can take as many different roads as you want to or need to, but there are some driving rules you have to adhere to. So same thing with self-direction. You get to be as creative as you want to. You have a blank canvas to, build your retirement wealth, but you want to make sure that you're following the rules. You don't have to know every rule, but definitely you can, allow us to do what we do best, meaning reach out to us if you have questions or need clarity on the IRS rules, or we can't give you any advice. But in terms of, hey, these are the guidelines, these are the rules that are in place that you need to be mindful of, I would say yes. And then two, the IRS just hired a whole bunch of new agents. I suspect that they did it for a reason. So I don't want to scare anyone, but again, be mindful of, if you know it's prohibited, don't do it. If you have questions about it, then reach out to us to get clarity on it.
Yeah, I think they're still trying to catch up from the 2020 and 2021 tax filings, but that's a good point.
Colm seems a little nervous right now, Reneika. I don't know about you.
No, I mean, Michael Jordan's my favorite player. So I would love to have a collectible, but I wouldn't want to put it in my IRA.
I heard a side note that there was a fellow doing flips through one of his retirement accounts, and everything was going smoothly until apparently the retirement account had a credit card, and he had a contractor that was buying materials for the house to build, which was fine. But then the guy bought some potato chips or something at the checkout of Home Depot, and that flagged it somehow. I don't know how, but that's just a story that I heard because that was a personal purchase on the IRA credit card.
Well, debit card. It can't be a credit card.
Debit card. Yeah.
Going back to checkbook, like line of credit, you can't personally guarantee. So please, I know when you open up a bank account for that LLC, banks usually offer you credit card. Just get a debit card or checks, hence checkbook. But to your point, no, you don't want to take the debit card and buy a bag of chips or go to Miami or Vegas and party. You don't want to do that. You don't want to commingle any funds.
So, you ruined Colm's weekend, Reneika.
Yeah.
Just right now. And I just lost track of the last question I was going to ask you. Do you have any questions, Colm?
Yeah. So you mentioned that the maximum I can contribute is $66K. Is it also, so that's for a solo 401k. Is that also at 66,000 or up to 1/3 of your personal income that you would pay yourself on a solo 401k, correct?
Okay, so
it's an either or maximum for how much you can contribute. And
so it depends, it varies. So really quick, let's touch on IRA's contribution and then we'll go back to solo 401k just because it's going to require a little bit more.
This question.
For IRAs, whether it's a traditional or Roth IRA, you can put in for 2022, you can put in 6,000 if you're under the age of 50, meaning 6,000 total. So if you have both a traditional Roth, you can decide to put 3,000 in one, 3,000 in the other, or however you want to break it up. But it's 6,000 total. If you're under the age of 50, 7,000 if you're over the age of 50. It's going to bump up a little bit next year to 6,500 and 7,500. If you have HSAs for right now, you can put in 3650. It's going to go up a little bit more next year for single. You have ESAs. It's going to stay at 2,000 per year per child. Specifically going to solo 401ks, though, you get to contribute twice in a sense, as the employee and also match as the employer. So depending if you don't have any W-2 and you're not participating in a W-2, let's just say you have your own business, well, for your solo 401k, as the employee, as the worker, for right now for 2022, you can put in 20,500. Next year, that's going to bump up a little to 22,500. So you get to put in as the employee, but also as the owner of your own business, the employer, you get to match possibly up to 25% of whatever the business made. So let's just say for simplicity, the business made 100,000. You as the employee, you're putting in 20,500. And then the owner, as the owner, you're also matching 25%. Well, that gives you about 45,000. But your actual maximum amount that you can contribute in a solo 401k, if you're under the age of 50, right now is 61,000. If you're over the age of 50, you have that additional catch up to where you can put in 66,000. So it just really depends. I know too, a lot of times I get questions like, well, hey, I have a W-2 401k that I participate, but I also have a side job. How does that work? So if you've maxed out your W-2 401k, put in the 20,500, and you have your side business and you're making income from that side business, well, because you've maxed out your W-2, you can't contribute to the employee portion of your solo 401k, but you can still match as the owner of your solo 401k. Or let's just say you put in 10,000 at your employee at your W-2 401k. Well, that means you still have 10,500 that you can put in on your solo 401k if your business, as long as your business has that income coming in. So it just really depends on your specific scenario.
That's really interesting. Let me ask you this, because this is the situation for a lot of our investors. They invest in real estate as a passive investment, but some of them have these, maybe investment properties, single family homes, things of that sort. They file a Schedule E on. Could that be considered a independent business of itself if it's just a Schedule E and not like its own entity?
So in order to contribute, they have to have earned income. So if it's just passive rental, unfortunately, that's not considered earned income. But let's just say if they're the property manager, they can obviously work with their CPA to pay themselves as a property manager, and then they can use that to make a contribution. So that's one way. But if it's just passive income rental check, then they cannot contribute that to an IRA or a 401k.
I see. So you pay yourself. Is it through a Schedule C? You pay yourself through a Schedule C as like a property manager or what have you, and then you can.
Yes, and I would say, that's definitely a question they want to loop in their CPA or tax person. But they would have to show that they're paying themselves earned income, and then they can elect to make a contribution to their retirement account.
This is fantastic. Yet we all have 1 month to implement this.
December is our busiest month, so usually everybody wants to get everything done before
making a checklist.
Year, so.
And what about Reneika? Like there are people obviously that are listening to this webcast. They invest in real estate, but then as they get this passive income flow, they've got some cash that they're just sitting there. What do people do with that in general? What kind of other investments do people put that money in? Because a lot of these real estate investments require a minimum, and they don't have that much in their account. So what are some other options that people have?
So clients have, pretty much discretion on what they choose to invest in. At Advanta, we don't have a list of investments for a client to choose from. If they have cash that's just sitting idle in their account, it is FDIC insured, but it's not gaining any interest. It's just going to sit there and tell the client, say, hey, I want to do X, Y, Z. When it comes to self-direction, they can elect to reinvest it into another alternative asset. So whether it's tax lien or it's, precious metals, or it's, some other type of real estate, maybe a joint venture partnership on a project. They have a long list of things that they can do, or they can elect to move it back to their traditional brokerage account, meaning, their IRA, where they can put it in the stock market if they choose to. Or if Viking Capital has a next project, they can just elect to, accumulate those funds and then reinvest it into one of your projects. With real estate investing specifically, it's pretty broad. So most times passive investors just do a syndication project, or they, lend, act as a lender. So they just have to go out and find what opportunities that they want to invest in. While we don't tell them what to invest in, we do have, obviously we do joint educational events like this where experts are talking about projects that they're working on. We also have something called Pitch, Promote, Prosper. It's open to our clients. It's open to the general public to where they can possibly source through other opportunities out there.
So if people are curious about other types of investments, there are some resources that they can get through Advanta to figure out what else is out there.
Yeah, absolutely. We have a lot of, ebooks and materials in terms of self-direction options, investing options. Obviously, our YouTube channel or our website, advantaira.com, is a great resource for different types of investments or things that you can do in an IRA. Specifically, if you're looking for like, hey, I have money in my IRA and I just want to see what's out there, you can go to our YouTube channel and look at some of the guest speakers we've had in the past. They can go to our website, check out our events page, and maybe look to join what's called Pitch, Promote, Prosper. It's, every other Friday. We're not endorsing anything, but typically you have an investment provider like Viking Capital on there saying, hey, I have a project that I'm looking, I have a project that's up and coming, or this is what we're offering, or we can have a client on there say, hey, I may have some funds coming available and I'm looking to put it somewhere, in the near future. So.
Excellent. Colm, do you have any other questions before we conclude?
I was just kind of curious about the earnings that are received, and if that if that goes towards the amount that I can contribute back into my IRA at the end of the year. So let's say I invest and then I get money back from, we have an exit, get money back. Does that automatically go into the account, and does that reduce the annual? Does that subtract from the annual amount that I can contribute to the IRA account?
No, so your earnings are actually unlimited. You have the ability. So there's 3 ways you can fund your account, one of which is making an annual contribution, transferring from an existing IRA, or moving funds, rolling over funds from a former employer plan like a 401k or 403b. So that doesn't count, but like contribution, rollover, transfer doesn't count against your actual earnings. So let's just say someone rolled over, $50,000 and they did an investment, and now that investment is now $75,000. Well, next year they can go and continue to make their annual contribution, or they can move additional funds. So the earnings is unlimited. It doesn't count against, whatever you're contributing.
Excellent. Reneika, this was amazing. Really appreciate all your advice. One question that somebody asked was, are the fees that you have to pay, can they be taken out of the self-directed or 401k itself, or do you have to pay them outside of that?
So there's two parts to that. So any related costs associated with the investment is paid by the retirement account as well. So let's just say buy property and there's property tax, it's paid out of the retirement account. For your Advanta related fees, you have 2 ways. You can have it deducted from your account, or you can have it deducted from a card on file. So that's the distinction. You can have it say, hey, let's just say someone moved over, $60,000, or let's just say they moved over $51,000, but they only needed $50,000 to make their investment. They keep $1,000 in their Advanta account, and they could say, hey, Advanta, instead of charging my card, deduct your annual fee from the actual cash that's left in the account. If it's a fee or cost or an expense related to the actual investment, then it's paid directly out of the retirement account. You can't pay it from your personal card or reimburse yourself in that scenario.
Excellent. Yeah. And what I've done is I've got all the fees paid for through the Advanta account itself. So that's also a tax deferred situation. We can pay your fees that way. Excellent. Reneika, this was amazing information. Really appreciate all what you shared. If investors want to reach out to talk to you, what's the best way to do that?
The easiest way is go to advantaira.com. You can definitely, once you get there, you can find our phone number. You can find my extension and give me a call. You can schedule a consultation directly with me online, or you can connect with me on LinkedIn. So those are the two easiest ways. I can also provide you guys my phone number, but if you go to advantaira.com, just click on schedule a consultation, and you should be able to reach me directly.
Wonderful. Thank you so much.
Thank you. I really appreciate this. Great questions, and I look forward to working with you guys in the very near future.
Thank you.
Bye.
Bye. Thank you.